Well, good morning, everybody. Welcome back to Strongman Personal Finance. I'm your host, Christopher Bell, and I am on holiday leave, so I have all day to make videos for you, okay? So if you want to hear more, if you like my channel, if you like how I look and how I dress, because you can trust a man that gives financial advice in a robe, right? Like the video, subscribe to my channel, hit the bell button for notifications, and drop a comment if you want to have a reasonable discussion with me. Unless you want to talk about Tesla stock, then you can get the hell off of my page. Anyway, welcome back to my channel. Today, I'm going to tell you why, if you have a major position in Qqq Etf, you need to get out of that right frickin' now and buy a much better ETF that gives you more diversification, also known as VTI. Now, what is Qqq? Well, I've got it right here for you on the screen on the left side. Qqq is the Invesco Trust Series 1. It tracks the NASDAQ 100 index, which is the largest 100 non-financial stocks that are traded on the NASDAQ. Now, if you look at some of the stocks in this index, they might be familiar to you. And let me scroll down and show you. In the NASDAQ 100, we have Apple, Microsoft, Amazon, my favorite, Tesla, and many other names that you can easily recognize. We all know what these are. Are these good companies? Absolutely. Are they going to grow in the long term? Absolutely. But what is the major problem with Qqq? Can anybody tell me that? Anybody? Anybody in the audience? No? Here it is. The investments in Qqq are way too concentrated. There are too few companies that make up the majority of this index because it is market capitalization weighted. For example, look at Apple. Apple alone makes up 12% of this fund, almost 13%. So if you buy one share of Qqq, 12.8% of that share is Apple. That's a little concentrated in one large company. And then you go down the list. The next one, Microsoft, 10%. Next one, Amazon, 10%. And then, of course, Tesla, the greatest investment of all time, that'll go up forever, 4.24%. That is way too concentrated. When you're investing, you want to be as diversified as possible, which means you're not putting your money in any one company. Now, putting 12% of your money in any company, no matter how good it is freaking stupid. So if you're buying Qqq right now, you're literally just buying 10 companies. And you're buying 100, but you're basically just buying 10 because they make up the vast majority of that index. And that is a terrible idea. Now, we've had a bull market with large cap stocks. And it's been great for U.S. investors that bought large cap stocks, especially tech stocks. But guess what? Bull markets in certain sectors never last forever. You might have small stocks do really well for a time, and then you might have large cap stocks do well for a time. Or you might have international stocks do well for a time. You want to be as diversified as possible so you get exposure to every single sector. Because you never know. Our large caps did very well the last 10 or 20 years, but they could completely freaking tank going in the future or stay flat. Excuse me. I'm not refilming this. I go off the cuff. So, what else do I like about Qqq? Not only is it very non-diversified, basically, 55% of the investment is in 10 freaking stocks. It's also highly concentrated in the tech sector. 47% of this investment, of this ETF, is in the tech sector, okay? And tech is great. There's nothing wrong with investing in tech. But if you invest in a total stock market index, you're also exposed to tech, but you're not exposing your savings to one sector, okay? Which is what this is doing. IT, 47%. The next one down is communications, which is 20%. This is highly concentrated, which is extremely risky. All right, one more point I want to make. I already talked about how sectors rotate. Large cap stocks do well. Then maybe the next decade, small cap stocks in the U.S. do well. And then maybe international stocks do well. Well, what do we have in the Qqq? 94% of the stocks are large cap stocks. And the rest, 5%, are mid caps. You're only buying large cap growth companies. That is a very narrow slice of the investing universe. You don't want to be concentrated in any one sector. You don't want to be concentrated in any one stock. And you don't want to be concentrated in any one category. Large growth, large value. You want to be diversified and spread over all the categories because they rotate. Now, what is a better place to put your money? If you have a bunch of money in QQQ right now, and hopefully it's in a tax advantage account so you can sell it, not pay taxes, and invest in something else, where can you put your money? Well, let me tell you. You can put it in the Total Stock Market ETF provided by Vanguard, also known as VTI. Now, before I go on, I know stocks aren't good for everybody, okay? And I'm not a licensed financial advisor because, they're so smart. But I can talk about VTI, and you can make the determination if you want to invest in it or not. All right, so let's look at VTI. VTI tracks the, CRISPR U.S. Total Stock Market Index. If you invest in VTI, if you buy a share of VTI, you're literally buying ownership of every single freaking stock in the United States that is publicly traded, which is pretty cool. That's a pretty cool concept. What is good about this ETF? Number one, you're way more diversified. Look at the comparison. Compare this Apple to Apple. Apples to apples. In QQQ on the left, you have 12.8% of your freaking investment is in Apple. On the right, it's only 5%. Can you see me on the screen down there? So, that is a much better ratio. That's still pretty heavily concentrated in one stock, but I'd rather have 5% of my portfolio in one stock versus 12 or 13%, okay? So, the top 10 stocks only comprise 22% of this index, which is a lot better. Still concentrated, but a lot better. Look at the sector exposure. In QQQ, you almost have 50% IT exposure. In VTI, you only have 26%. And you have exposure to a lot of different sectors, which is good. You want diversification. Some sectors do good, and some don't. And then they rotate because investors pile in and they pile out. All right, what else? With VTI, you're going to be invested in North America. You're going to be invested in North America, aka the United States, and it's only U.S. stocks. But it's still a lot more diversified than QQQ, all right? The last point I want to make about VTI. In QQQ, you're 99% large cap growth stocks, all right? And you have 5% mid caps? In VTI, only 72% of your investment is in large caps. Still concentrated, but a lot better. You have not 20% exposure to mid-cap stocks, and you even have some small and micro-cap stocks. So you're actually capturing some of these very small companies that can potentially grow massively over time. For example, if you didn't really know what Tesla was back in the day when it was a micro or small cap stock, VTI would have purchased Tesla. And then you would have captured the gains of Tesla, the gains that are totally sustainable, going from micro to small to mid to large because the index held it. Now, if you were in QQQ, you wouldn't have captured Tesla's gains until it actually grew large enough to be included in the index, okay? So I implore you, if you're piling into QQQ because it's done so well in the past, that's not a good idea. It is way too concentrated. Instead, you want to invest in something like VTI if you're looking at U.S. stock market exposure because you're exposed to the entire stock market. You're going to catch every single company. Some will be winners, some will be losers, but it's better to have that than to be highly concentrated, okay? Just do it. Just trust me, bro. I wear a bathrobe, all right? Like the video, subscribe to my channel, hit the bell button, leave a comment, and I'll see you guys later. Tschüss.